Everyone's still busy debating whether Bitcoin is going to $1 million or straight to zero. But what if they're asking the wrong question? What if the argument for Bitcoin is already broken? For years, the story was simple. Bitcoin was our escape from a devaluing dollar, a shield against endless money printing. For a while, that story even seemed to work. But things have changed. You've heard the pitch. Bitcoin is a safe haven. It was an idea that held up for over a decade, but we're in a new era now. Bitcoin isn't the scrappy outsider anymore. It's gone mainstream, with ETFs and big institutions flooding in. And that's brought Wall Street's problems right to its doorstep. Data has shown an increasing correlation between Bitcoin and tech stocks, especially since the ETF approvals. It's not acting like a hedge, it's acting like a high-risk tech bet. Today, we're not here to spread fear, we're here to look at the data. In this video, we're exposing 3 ticking time bombs that suggest Bitcoin's fundamental promise has already been shattered. The first and most immediate issue for Bitcoin is the very thing that was supposed to ensure its success: institutional adoption. The launch of Bitcoin ETFs was cheered as a final victory, the moment Wall Street finally took the asset seriously. But it looks more like a Trojan horse. What we got wasn't validation, it was a leash. For most of its life, Bitcoin's price was driven by a unique community of believers who would hold on through 80% crashes without blinking. They had diamond hands because they believed in the decentralized philosophy. Institutions, however, don't. Hedge funds and asset managers operate on one principle: risk management. They care about quarterly returns and margin calls, not a white paper. And the data shows this shift. With institutional money pouring in, Bitcoin's correlation with the Nasdaq has tightened. It no longer consistently acts as a hedge. It often acts as a leveraged bet on the same speculative energy that drives tech stocks. When the market gets turbulent, what do big funds do? They often sell their most liquid assets to cover losses elsewhere. Increasingly, that means Bitcoin. This can trigger a cascade of deleveraging. A price dip isn't just a dip anymore. It can become a brutal unwind of leveraged positions that sends the price spiraling. This isn't a bug, it's a new feature of an institutionalized Bitcoin. Even executives at major players like BlackRock have publicly warned that extreme leverage in the crypto derivatives market is creating massive volatility, noting that cascading liquidations and auto-deleveraging can cause huge price swings from minor events. This kind of volatility is a major red flag for the conservative long-term capital Bitcoin needs to survive. In the past, a crash was a buying opportunity for believers. Today, a crash can be met with automated sell-offs and margin calls, each pushing the price lower. The safe haven becomes the first thing thrown overboard. Bitcoin isn't separate from the legacy financial system anymore. It's been absorbed by it, inheriting its systemic fragility. The second ticking time bomb isn't in the market. It's buried in Bitcoin's own code. For years, a quantum computing attack was seen as sci-fi, a problem for the distant future. That future is getting closer, and experts are debating the timeline. The real vulnerability lies in Bitcoin's past, specifically its oldest addresses. An estimated 25% of all Bitcoins, including those belonging to Satoshi Nakamoto, are in pay-to-public key or P2PK addresses. These early wallets have a critical flaw. The public key is directly visible on the blockchain. Modern addresses are more secure because they hash the public key, obscuring it until a transaction is made. But for these old wallets, the blueprint to the key is already exposed. A powerful enough quantum computer running Shor's algorithm could theoretically derive the private key directly from that public key. While no such computer exists today, the pace of development is a known risk, with some experts predicting a threat could emerge in the next decade. The moment even one of these old high-value wallets is publicly compromised, the trust in Bitcoin's core promise, digital scarcity, is broken. If a quantum computer can effectively steal old coins, the idea of a fixed supply of 21 million becomes an illusion. It would create a bank run on digital gold. Who would want to own an asset whose security is on a countdown clock? The value wouldn't just drop, it could evaporate. While this threat develops, the network's security is also impacted by price. Extreme price volatility puts pressure on miner profitability, and while the network has proven resilient, it's a dynamic worth watching. The final nail in this coffin is being hammered in by governments worldwide. For years, Bitcoin thrived in regulatory gray areas. That era is over. The regulatory noose is tightening, and it's systematically dismantling Bitcoin's core value propositions. Governments aren't trying to ban Bitcoin outright. They're taming it. In the European Union, the Markets in Crypto Assets (MiCA) regulation is now in its implementation phase, establishing a comprehensive legal framework for crypto assets and service providers. In the United States, new tax reporting rules are taking effect, with the IRS rolling out Form 1099-DA for brokers to report user transactions. The days of easy anonymous transactions are numbered. This regulatory squeeze does two things. First, it chips away at Bitcoin's utility. Every transaction now comes with a clearer compliance cost and a data trail. It's being molded into a more transparent, surveilled version of the system it was meant to replace. Second, it neuters the censorship resistance argument. If every on-ramp and off-ramp is a regulated choke point, Bitcoin is no longer outside the state's control. Governments may not stop the protocol, but they can make it very difficult to use without their permission. This new reality is a red flag for the very institutions Bitcoin courted. With its utility as a censorship-resistant medium of exchange being legislated away and its role as a store of value undermined by volatility, what's left? A speculative token with no clear purpose, facing competition from faster, cheaper, and state-sanctioned digital currencies. So, let's recap the three blows. First, the institutional Trojan horse has tied Bitcoin to the mainstream market, making it a risk-on asset. Second, the quantum flaw in its old code puts its fundamental security on a timer. And third, the global regulatory noose is strangling its utility. Bitcoin likely won't vanish overnight. Its end could be a slow fade, as the market deems it too risky, too volatile, and too compromised to fulfill its original promises. The data screams caution. Ignoring these signals, the correlation, the leverage, the regulations, is starting to feel more like an act of faith than a sound investment strategy. This isn't financial advice. It's an analysis of the facts as they stand today. The ship is taking on water from three different directions, while many people are still just watching the price. What are your thoughts? Do you see a way for Bitcoin to navigate these flaws, or is the writing on the wall? Let me know in the comments below. And if you appreciate this kind of data-driven analysis, make sure to subscribe.